right, my clock shows it's just after 10 o'clock. I think we can get started here. Good morning, everybody. My name is Tyson Moore. I'm a supervisor in the not-for-profit division here at DWD. I want to take this time to thank everybody for joining today's webinar covering understanding unrelated business income. With us today, as always, is Susan Berghoff, a director here at DWD, along with our presenter, Carrie Minnick. Before I get started, I do have a couple housekeeping items to cover. For those who have questions during today's webinar, please use Zoom's question and answer feature. You should be able to find that option in the toolbar at the bottom of your screen. Both Susan and myself will be answering questions periodically throughout the presentation. Also, Carrie's slides will be emailed to everyone attending the webinar today, along with being posted to our website after the presentation is finished. I think that's everything I needed to cover this morning. I'll now turn the floor over to Carrie to start today's webinar.
Thanks, Tyson.
Yep.
Again, thank you all for joining us today as we talk about unrelated business income. Before we get started, I just wanted to go over some of the basics behind unrelated business income in tax-exempt organizations, just kind of to set us up before our discussion. First of all, as we know, tax-exempt entities, which are nonprofits, do not have to pay federal income tax. So that's what we know. However, tax-exempt entities do have to pay unrelated business income taxes, which is, we're going to refer to that as UBIT, or unrelated business income as UBI, on income that is generated by activities that are not substantially related to their tax-exempt purpose. And this tax that is paid at the same rate as the corporate tax rate, which is 21%. And when we're talking about UBIT and tax-exempt entities, this also does apply to churches and religious organizations as well. UBIT is really has been put in place to ensure that your organization focuses on its tax-exempt purpose. So you received a tax exemption from the IRS because you met a specific requirement that said you have a specific mission, programming, that meets the tax exempt rules. So we want to make sure that the organization follows that. That's your main purpose. UBIT also eliminates the unfair competitive advantage your organization may have on a similar or on a for-profit business that's doing something similar. So if your organization has a coffee shop, let's say, selling coffee, and there's a for-profit business down the road that's selling coffee, doing the exact same thing, why should your organization, just because you're a nonprofit, not have to pay taxes on it while the for-profit does have to pay taxes on it? So that's kind of why they instilled this concept of UBIT. We need to remember a couple things. Unrelated business income can only make up an insubstantial part of your organization's total funding. Excessive UBI can threaten your tax exempt status. So when we're talking about unrelated business income, it is okay for your organization to have some unrelated business income. You just cannot have a lot. You can't have a substantial amount. Because if you do, then that really can threaten your tax exempt status, because then the IRS is seeing you as you're doing a for-profit mission. You're not focusing on your nonprofit, your tax exempt purpose. It does not matter how you spend the income. So when you get this, when you generate income, it doesn't matter if it's all going back into your mission. It doesn't matter if it's going back into to feed the programs. The IRS focuses solely on the specific activities that generate the income and determining if it's unrelated. So it doesn't matter what you do with the money. It only matters how you got that money into your organization. Unrelated business income determinations are almost always based on specific facts and circumstances. So what this means is that an activity could be considered unrelated business income for one nonprofit, but another nonprofit could be doing the exact same thing and it may not be considered unrelated business income. So unrelated business income activities is a very gray area, and we really need to look at all of the facts and circumstances around that specific activity to determine if it is unrelated or not. The basic definition of unrelated business income is it has to meet these three specific criteria, and it has to meet all three of them in order to be considered unrelated business income. The first is it needs to be a trade or business. Secondly, it needs to be regularly carried on. And finally, it has to be not substantially related to the exempt purpose. So if all three of these characteristics are in place, then the activity is probably considered unrelated business income. So let's take a little bit deeper dive into what each of these mean. The first, trade or business. So this is an activity that is carried on to produce income, sell goods, or perform services. So just kind of what you think it is. You're selling something, a service, an item, you're doing a business. When we're talking about what a trade or business is, one of the things that is very common in this discussion is the commerciality doctrine. And really what that looks at is the similarities between the activities that your nonprofit is doing versus a for-profit that's doing the same type of activity. So we're looking to see, are we selling the item in a similar manner? Are we advertising and marketing it in a similar manner? What kind of methods are we used to marketing? Is it aimed, when we're selling an item or a service, is it aimed at selling it to the general public where anyone can come in and take advantage of that service or purchase that item? Or are we focusing it just on our main clientele that we serve as a nonprofit? And then also, is there a profit motive in place? What are our pricing strategies? Are we pricing it below market, or are we pricing it what a for-profit would be doing so down the road? So really, if it looks like an activity that for-profit would be doing as a business, then it probably is. So one thing, if you're taking on new activities, when you're evaluating whether that activity could be a unrelated business income activity, you want to see and think, okay, is there another for-profit entity that is doing something similar? And if there is, that is probably a red flag that could be considered unrelated business income. And again, unrelated business income is okay. We just don't want to have too many of it. So that's the first thing, trade or business. Second is regularly carried on. So we have to look at the frequency and also the continuity of the activity, and how is it pursued in comparable manners with for-profits. So if a for-profit usually conducts this activity quarterly and you're conducting it quarterly, then it's probably regularly carried on. Excuse me. An activity could also be done annually, weekly, seasonally, or sporadic. Usually an annual fundraiser is probably not considered unrelated business income. However, if you have a weekly event, it may be frequent enough to be considered unrelated business income. Again, we have to look at the facts and circumstances that surround this activity. However, short-term activities, which are usually sporadic or intermittent, are usually not considered activities regularly carried on. However, if we have seasonal activity, that it may be considered regularly carried on, even if it only occurs for a short period every year. For example, like during an annual summer conferences or holiday activities. So the activity that's creating the income doesn't necessarily need to be ongoing throughout the whole year to be labeled as regularly carried on. It could be monthly, it could be quarterly. It just, again, depends on the different case. I've provided some examples from the AICPA nonprofit section to kind of help see some different instances. For example, a sandwich stand operated for 2 weeks annually during the state fair is probably not considered regularly carried on. It's not consistent throughout the year. It's just a one-time for 2 weeks, very short period. However, if you are operating a parking lot every Saturday night, so that's weekly, every week during the year, that's probably considered regularly carried on. If you have a golf tournament every month, so again, reoccurring every month during the year, it's regularly carried on, is probably considered regularly carried on. However, if you only have a golf tournament twice a year, it may not be regularly carried on. A golf tournament once a year for your annual fundraiser probably will not be considered regularly carried on. So again, we need to look at the facts and circumstances that surround the activity, but we also need to look to see, okay, of this activity, how often do we do it? Is it consistent over monthly, quarterly, annually, and then determine if it's regularly carried on or not. The final characteristic that must be in place in order for an activity to be considered unrelated business income is that it is not substantially related to the organization's mission or purpose. An activity is not related just because it raises funds that can be spent on exempt purpose activities. So again, just because that money that's coming in from this activity is going to a specific program that is part of your mission, that doesn't count. The IRS specifically has ruled that that does not matter. The activity needs to be substantially related to your mission. Congress has, so those are the three characteristics that have to be in place for the activity to be considered unrelated business income. However, Congress has specifically stated that there are certain types of revenue that are excluded. They are not considered unrelated business income. So these activities are generally passive in nature, and they include some examples that I have on the screen. Interest and dividends. So your earnings that you have on your investment account, your endowment account, those are not considered unrelated business income, even though they do occur regularly. Your investments probably have nothing to do with your actual purpose, your mission. However, the Congress has said these are excluded from unrelated business income. Royalties, if you get any royalties, gains and losses from the disposal of capital assets and investments. So when you sell your fixed assets, if you have old equipment that you sell and you receive a proceed on that, and it's more than the actual value of the asset, that is not considered unrelated business income. Again, even though that activity has nothing to do with your main purpose, Congress has said that is not considered unrelated business income. Same goes with investments. If you sell some of your investments, that is also excluded. Certain types of research activities are also excluded. And then rental from real property. So if you're renting a part of your building, that is specifically excluded from unrelated business income. However, if it is debt financed, so if it has a mortgage on it or debt on it, then it can be considered unrelated business income. So we'll talk about that next. So again, debt finance means that you have a building that either has a mortgage on it or has some kind of debt on it, on the property. So that's the first thing that must be in place. And then you are renting this space out and receiving rent income for that space. Then portion of that rent income is going to be taxable as unrelated business income. There is a calculation that is done that looks at the average acquisition indebtedness. The calculation is kind of complicated. So if you have this in place, you might want to contact your CPA, your accountant, to make sure that you're doing that calculation correctly. However, there is an exception. So if substantially all of the property, so all of your building space, is used for your organization's tax exempt purpose, then none of it's going to be considered unrelated business income. So for example, let's say you have a building and it's your office, your main office at your headquarters. There is a mortgage on this building. Let's say that you use 90% of this building for your purposes. Your organization uses it for your tax exempt purpose. And 10% of this building space you rent out to somebody else. It can be a nonprofit or it can be a for-profit that you're renting out to. Doesn't matter. So because 90% of that building is being used for your main purpose, your tax exempt purpose, that 10%, the IRS says that's fine. It's an exception because you use most of your building for your tax exempt purpose, we're going to just ignore that 10%. It's not going to be considered unrelated business income. When they say substantially all, usually it's 85%. So if you use 85% or more of your property for your tax exempt purpose and you rent out the rest of it and there is a mortgage on that building, then you're likely not going to have any unrelated business income. Now, unlike real property, the buildings, rental of personal property is normally considered unrelated business income. So that's going to be if someone is renting I don't know, vehicles or equipment from you, that's personal property. So that's usually going to be considered unrelated business income. Sometimes there are leases that include a combination of both personal property and real property. And so if you have something like that where the lease includes both of those and there is a mortgage on that lease, you're going to have to, there's some calculations that need to be done to split that and to determine how much of that is unrelated business income. So again, if you have something like that in place, you're probably going to want to contact your CPA to make sure that that is being done correctly. So like Congress has said that there are certain revenue streams that are specifically excluded, they've also said that there are certain types of activities that may be exempt from UBIT, even though those activities are not substantially related to the nonprofit's exempt purpose. So maybe they do meet those three requirements that they should be unrelated business income normally. However, IRS has specifically said, if you have these in place, they're exempt. They are not considered unrelated business income. So the first is the volunteer labor exception. So if you have an activity and substantially all, so again, substantially is usually considered 85% of the work for this activity is performed by volunteers, then it's exempt. It's not considered unrelated business income. So let's talk a little bit about volunteers. So volunteers are people that are not compensated and have no expectation of financial benefit for their work. So we're not saying, hey, here's our staff people and our regular employees and staff are going to volunteer to do this activity. That's not what we're talking about here. We're talking about true volunteers that are giving of their time and not receiving anything in return. Now you can, if you have an activity that has a majority of people that are volunteers, you can use some paid employees for the activity. But again, you just need to make sure that substantially all of the activity is performed by volunteers. And again, it doesn't necessarily say in the statute what the substantially all is, but the IRS has recommended in other areas 85%, and that it's measured by total hours worked in the activity. The next specific activity that is exempt is the convenience exception. So these would be activities that are being done for the convenience of members, students, patients, officers, employees, those individuals who have a direct relationship with the organization. So if you're bringing money into your organization from an activity, but it is because of convenience for these individuals, then it is not going to be considered unrelated business income. Some common examples include like school cafeterias, hospital gift shops, patient parking lots. These are items, these are provided at nonprofits for, again, the convenience of the employees, of the people using the services. Otherwise, they would need to, take the time, go off site to get these services. So in order to make it more convenient for the people using the nonprofit services, the nonprofit has just provided these on site. Income from a cafeteria or a vending machine, that's usually considered exempt, again, because of the convenience exception. The next exempt activity is selling donated goods. So this is really the thrift shop exception. So these are like secondhand stores or the auction of donated items at charity fundraisers, where all the revenue that you get from selling these items is excluded when the items are sold, if they're all received by donations. So again, just making sure that those items are being donated to the organization and not sold or not purchased. And then you're selling those, bringing money in. It's not considered unrelated business income. The next exempt activity is low cost items. So these are really those small things, the coffee mugs, the tote bags that relate to soliciting contributions. So for an example, if a nonprofit has a fundraising drive and gives a very small gift in return for their donation. So, hey, if you give us a donation of a certain dollar amount, we'll give you a coffee mug, coffee mug, how much is, the value of that? So the individual is giving you money, is paying you to make the contribution. They are not paying for a coffee mug. They are not expecting to get the coffee mug in return. So these are considered low cost items. So the money brought in from this activity is not considered unrelated business income. The IRS does state what a low cost item is for this purpose. For 2022, that amount is $11.70. Next are qualified sponsorships. And this one can get a little fuzzy when we talk about qualified sponsorships versus advertising. So if an organization receives qualified sponsorships, a qualified sponsorship is not considered unrelated business income. If an organization receives advertising income, advertising is considered unrelated business income. So it's important to understand the difference between the two. So a qualified sponsorship is a payment made to a nonprofit without the sponsor receiving a benefit in return. So if there's minor benefits, for example, we are thanking our sponsors, we're showing the sponsor's name and logo, that's fine. That is not considered a benefit. However, if we are saying, thank you to our sponsors, they are wonderful at the services they provide, please go and use their services, that is considered an advertising because we are endorsing or in trying to induce people to use their to purchase the donor's products or services. And so that is considered advertising. So if you are selling advertising, that's perfectly fine. You're going to have to pay unrelated business income tax on it. However, if you are receiving qualified sponsorship, that is not considered unrelated business income. So if it looks like advertising, it probably is advertising. If you call it advertising, it is considered advertising and unrelated business income. So you just want to make sure that if you truly have qualified sponsorships where the donor is not receiving anything in return, other than their just acknowledgement, they're showing their logo, thank you for their contribution, that's fine. That's a qualified sponsorship. We also need to be careful on your website. So if on your organization's website, you have a listing of your sponsors and there is a link to their website, you need to be careful what pops up when someone clicks on the sponsor's website link. Because if something pops up and it says it's like an advertisement on their website, then that's going to be considered advertising for you. So if your link goes to a sponsor's website that is trying to sell something on that first page, hey, come buy XYZ, then that's probably going to be considered advertising income to your organization. So it's important to make sure you're aware of what kind of links are on your organization's website, because those could possibly lead to unrelated business income. So next, I want to go over just some common activities that are considered unrelated business income. So we kind of talked briefly about advertising, and I think advertising is probably one of the most common activities for nonprofits that leads to unrelated business income. And again, you can have these items, it's perfectly fine. It's just we can't have a substantial amount of unrelated business income. Debt finance rental income, we talked about that. So if you have a building that has a mortgage on and you're renting it out, there could be unrelated business income as a portion of that income. The next is admin services. So this is actually, I think, becoming a little bit more popular. So sometimes nonprofits get really good at doing certain things for their organization, whether it be printing, creating newsletters, or maybe back office services like HR or IT support, or even accounting services. So when you're doing that for your organization, that's fine. That's part of running your organization. However, if you start providing these types of services, if you are doing accounting services for other nonprofits or providing IT support for other nonprofits because your IT department is really good, then they're paying you for those services, then that's considered unrelated business income. Because again, you are not in the business to provide accounting services to other nonprofits. That's not what your mission is. That's not what your purpose is. So we just want to be careful and be aware that if your organization is helping out another organization by providing those types of services and they're paying you for it, that money coming in could be considered unrelated business income. The next is sale of logo merchandise. So a lot of organizations will sell t-shirts, hats, bags, all kinds of items that have their nonprofit logo on it. That's fine. However, the selling of that merchandise is normally not specifically related to your organization's mission. And so therefore that money that comes in is likely considered unrelated business income. One thing I want to briefly talk about here with the sale of logo merchandise and just sales in general, beginning July 1st of this year, so July 1st, 2022, there was a change in Indiana to sales tax for nonprofits. So in the past, if a nonprofit made available something for sale for 30 days during the year, did not have to be 30 consecutive days, it could be a week here, a week there. If the item was made for sale for 30 days, then that nonprofit was required to collect and remit sales tax. That has now changed. So effective July 1st, 2022, the 30-day rule no longer exists and it has gone to $20,000. So if you are selling something and you are bringing in $20,000 or more from selling that item, you are now required to collect and remit sales tax. So again, that change is pretty recent. So I want to just make sure that everyone was aware of that. Also, along with that change, there was a change in how the nonprofits are going to maintain their sales tax exemption with the state. So as a nonprofit, you can apply for sales tax exemption. So when you go and purchase an item, you can be exempt from paying sales tax on that. You do that with Form NP20A, and that should be done when your organization first starts. So for many of you, you've probably did that a long time ago. But in order to keep that exemption, an annual Form NP20 has to be filed with the state each year in order to maintain that sales tax exemption. Effective July 1st, 2022, that is also changing. So going forward, that has to be filed electronically by the organization through the state's website. So that's online. And it also is going to be filed every 5 years as opposed to every year. There is a kind of in-between period that we're in right now where certain organizations, based on your EIN number, will determine when you're filing your next NP20, but then after that, it's going forward every 5 years. So if you have questions on that, please contact us. I just wanted to make everyone aware, since we are talking about sales, that there was a change in Indiana that is effective July 1st, 2022. So if you do sell items, have collected and remitted sales tax in the past, or thinking about that, just make sure that you are aware of that change that's happening. Online stores, if you have a website and you're selling items online, those items, again, sale of logo merchandise, sale of different items, more than likely they will be considered unrelated business income. We talked briefly about links on your website. So again, if you have banners, links to other websites, sponsors, other organizations, just make sure that you're aware as to what's coming up when you click on those links. So you might want to go through and click on all the links on your website and make sure that there's nothing coming up as advertising, or if there is, that is properly recorded as unrelated business income. Coffee shops. Coffee shops is a very common activity that we see for nonprofits that probably are considered unrelated business income. Now, in some instances, though, it may not be considered an unrelated business income item because, again, we have to look at the facts and circumstances. So if we have a nonprofit and let's say their purpose is to help people that have been in prison get back into everyday life, helping them, to get a job and that type of thing. And as part of that, they operate a coffee shop. And in this coffee shop, the people that are going through their program, that have just been released from prison, they're going through this program, they work in this coffee shop. That is probably not unrelated business income for that nonprofit because that is part of their mission. They're providing a job for the people in their program. However, if you have another nonprofit or maybe a church that has a coffee shop that sells coffee, has absolutely nothing to do with their mission, then it would likely be considered unrelated business income. So again, if you're thinking about selling coffee, just might want to consider what the effect is on your organization. And then finally, operating a parking facility or a parking lot. So, sometimes organizations will have a parking lot, or a church will have a parking lot that's, not used during the week. And so they rent out spaces to people during the week. That's not related to what the organization is doing. So that could be considered unrelated business income as well. Obviously, these are not all of the activities, but these are some common ones that we see. So if you do have any of these within your organization, you just might want to take a closer look at those and make sure that if any of them are considered unrelated, that you're recording the income properly as unrelated business income. So speaking of recording unrelated business income, if your organization has unrelated business income of $1,000 or more during the year, it must file Form 990T with the IRS to report that. And this actually includes churches and religious organizations as well. There's also a state form. So in the state of Indiana, that is called the IT-20NP. So these are the forms that you're using to report that activity with the IRS and the state. Now, we talked a lot about the income. So we know where the activity that creates the different income for unrelated business income. We can offset that income with the related expenses to determine how much tax we're actually going to pay on that. So the rules to compute the expenses deductible for unrelated business income are very similar to those for for-profit organizations. So expenses must have a proximate relationship to the production of the revenue. So only those expenses that are directly connected with the carrying out of this activity that's considered unrelated business income is deductible against the revenue on the 990T. So we can't just be putting a whole bunch of expenses that we have against this income to get our net income down to zero. The expenses have to be related to the activity. So this would include direct expenses, allocation of overhead or indirect expenses. It has to be allocated on a reasonable allocation. So just like you allocate your expenses between the three functions for your 990 already and for your financial statements, we allocate expenses between program, management in general, and fundraising. We're just going to have an additional allocation where we allocate some of those expenses against our unrelated business income activity. Obviously, expenses that the organization would have incurred regardless of whether they have the unrelated activity may not be allowed as a deduction on the 990T because we already have those. So we can't deduct those. It doesn't matter if we have the activity or not. Again, making sure that there is a reasonable basis for the allocation methods, making sure you have adequate records to support this position. Basically, the IRS will accept a reasonable methodology to allocate these expenses. If you have advertising, looking at, let's say you have an annual booklet or an annual directory that you are providing to members, people of the community, and in that directory you have advertising. So you sold advertising, that's considered unrelated business income. So then when we determine the expenses that are going to offset that, one of the reasonable basis to allocate printing is to go through and count how many pages have advertising in it. Is it a full page? Is it a half page? So again, the point is to have some kind of reasonable basis methodology in writing, preferably, to show how you're going to allocate expenses against your unrelated business activity, to make sure that you are not allocating expenses that don't relate to that activity. If you do report a high amount of UBIT, there could be a chance that you get an audit, that the IRS audits your organization, because again, you are not tax exempt to generate unrelated business income. You are tax exempt to do your primary mission, your program, what the IRS has given you that tax exempt purpose for. One other thing, in the past, several years ago, if you had multiple different unrelated business activities, you could net the activity together. So let's say you have debt finance, mortgage, rent income. So you're getting rent income from a building that you rent out. Let's say you have $5,000 net income from that. Let's also say that you have you sell advertising. And so from that, you actually had a loss of $2,000. So you have two different activities, rental income and advertising. In the past, you would be able to offset that. And so you would only have net income of $3,000. You cannot do that anymore. So we have to keep those separate. So your rent income and expenses on the, over here, and then your advertising income and expenses over here. They cannot be netted together. They have to be maintained, kept separate, reported separately on the 990T. If you do have to pay unrelated business income taxes, you may be required to pay estimated taxes throughout the year, just like for-profits and some individuals. Normally, if your tax liability is $500 or more, you might have to pay in some unrelated business income taxes throughout the year. So just keep that in mind as well. So, we talked about unrelated business income, what it is, where it comes from, and if you do have too much of it, it could threaten your tax exempt status, but you can have some. So how much is too much? The IRS does not provide a number. They do not provide a percentage, and they are very, there's no set standard that has been in place to determine this. For example, there was one revenue ruling that was issued on unrelated business income, and it said that 75% of this organization's revenue was related to unrelated business income. They said that that's okay. However, there was another case that said this organization had 33% unrelated business income, and they said, no, that is not okay. So again, it really is really based on the facts and circumstances of each situation. So we need to make sure we remember that. So, the IRS has a really big focus on unrelated business income, partially because it is a gray area, but also because tax exempt organizations represent a huge portion of our economy, and normally they don't pay any kind of taxes. So this unrelated business income tax allows the IRS to collect taxes from tax exempt organizations, which, that's what its purpose is to eliminate that unfair advantage over for-profits. So this tax was put into place for that. So that's kind of one reason why the IRS has such a large focus on it. And the IRS actually did a study, and I know that, 2008 seems like it was several years ago, but they did a study on colleges and universities and the way that the colleges and universities were reporting unrelated business income. And I think they found like 90% of the schools examined were required to increase the amount of UBIT that was reported on their 990T. They were not properly reporting unrelated business income. And then some of the other issues that they found were the schools were not allocating expenses properly, or they just simply misclassified activities as exempt. So I know this was just a study that was done a while ago, and it was only focused on colleges and universities, but usually that spills over to the whole nonprofit sector. So that's likely what the IRS is looking for on other nonprofit 990Ts as well. So again, I just want to, close with that. Generating unrelated business income is okay. So unrelated, you can have some unrelated business income, especially I know during the last few years with the pandemic, and a lot of organizations either had to, cut back on maybe their programs that they were able to provide, or, reduce some of that, that revenue that was generated. So nonprofits really had to get creative and to create new revenue sources, which is great. However, some of these new revenue sources probably led to unrelated business income, which again is okay. You just have to be careful that you're recording it properly and that you don't have too much of it compared to the rest of your organization's activities. Because the primary activity of your organization must be exempt. Again, you became a nonprofit, you are exempt from taxes because you meet that specific mission. So we want to make sure that that's really what our focus is on. And then again, also remembering that what is related for one organization may not be related for another. So if you see ABC nonprofit down the street doing something that you think, hey, they're allowed to do it, so I'm going to do it too, that might not be the case. You really need to look again at the facts and circumstances to determine for your organization whether that's considered unrelated business income or not.
All right, great job, Carrie. I just want to remind everybody that this session was recorded. So the slides and the video are both going to be available on our DWD website in the not-for-profit section. A link to this section will be emailed out to everyone who attended today. While you're on our website, please visit the not-for-profit webinar page where you can register for our next webinar. It'll take place on August 10th. It's going to cover accounting basics for fundraising activities. Also, while you're there, everything you see on the screen right now, those are all available to register. So you can register out throughout to the end of the year if you want to. With that being said, I want to thank everybody for joining us this morning. Have a great rest of your day.